This video shows you how to build a 3 financial statement model and discounted cash flow model investment banking style. I'll teach you how to do it with the keyboard, without the mouse. Subscribe, hit the like button, share this video with friends and family, and continue to watch for great content. Let's get into the video. I have the model open. This is a discounted cash flow analysis, unlevered DCF for a widget company. The widget company is the analogy for any company. A couple housekeeping things before we get too deep into it. Color coding scheme: blue values are hard-coded, black values are formulaic, green values reference intra-workbook tabs. I highly recommend you have your own color coding scheme in place when you're building Excel workbooks and specifically financial models. This workbook does have 2 intentional circular references, one for interest income and one for interest expense. Interest income is based on average of cash balances from beginning to end of period times an interest rate forecast. Interest expense, on the other hand, is based on the average of debt balances from beginning to end of period, and that's based on an interest rate forecast, just like interest income is. To deal with that, I have the option, and I've enabled the iterative calculation in my Excel workbook. That tells Excel to overlook the circularity and just find a stable state. Excel knows that it's an intentional circularity. First, I'll start with cost of equity. I got adjusted closing price data for a 1-year time period for a market benchmark and 5 comparable companies. Then I calculate benchmark return and the returns for the combined for the 5 comparables. That's just today's adjusted closing price divided by yesterday's adjusted closing price minus 1. And then based on that, I can use all that data to calculate the levered beta for each comparable in terms of covariances and variances, which I do in row 2, as well as risk ratios and correlation coefficients, which is done in row 3. You can see that row 2 equals row 3 for each column. That's good. That's just a way to sanity check the data. I made sure that I'm calculating the levered betas correctly by calculating it 2 different ways, and both got to the same result. I just made up some debt to equity ratios for this hypothetical example, but normally you can calculate those with financial statement data from SEC Edgar website. 1 minus tax rate. I have a tax rate forecast of 21% in the DCF tab, and so 1 minus tax rate is 79%. Then I use the Modigliani-Miller formulas to take the levered betas divided by 1 plus the product between the firm's net debt to equity ratios and 1 minus the tax rates, and that's how I get to the unlevered betas for each of the 5 comparables. I average those together and then re-lever them at the target company's capital structure, a debt to equity ratio of net debt to equity ratio of 0.33. That gets me to the levered beta of 0.76. I use a 10-year treasury rate from the U.S. Treasury website, and then I use Oswald Damodaran's forward-looking market risk premium. And these numbers may be a little bit out of date, but it still serves the point of showing you how to model these things. And then once I have all that data, I do the risk-free rate plus the product of the market risk premium and the levered beta of my company. And that gets me to a cost of equity of just over 8%. And so by levering and relevering the betas, we're separating out systematic risk due to financial leverage and systematic risk due to operating leverage to get an accurate understanding of the actual risks of the operations. Now for the income statement forecast, revenue is just trailing last year's revenue period times 1 plus revenue growth rate, which is in row 22. It's a 20% growth rate. Cost of goods sold is a plug, it's revenue minus gross margin. Gross margin is the product of the revenue and the gross margin percentage forecast of 60% in row 23. R&D and SG&A, research and development, selling, general and administrative expenses, are both linked to revenue times the forecast. So those are in row 24 and 25. R&D is a percentage of revenue, and SG&A is a percentage of revenue. That gets me to EBIT, earnings before interest tax. Interest income and expense are linked to the interest income and expense schedules lower down in the Excel workbook, which I will go over. Other expense, I'm just straight lining. That gets me to earnings before tax. I have a tax rate forecasted in row 26. And then based off that, I'm able to calculate taxes, pre-tax income times tax rate forecast, sum those up since it's a negative number, and that gets me to net income. Add back depreciation and amortization, which comes from the property, plant, and equipment schedule. That gets me to EBITDA. Add back stock-based compensation expense, which I grow with the revenue growth rate in row 22. That gets me to adjusted EBITDA. That's the income statement forecast. On the balance sheet, cash and cash equivalents references last year's cash balance plus or minus the net change in cash on the cash flow statement. Accounts receivable is just grown with sales, the 20% sales growth rate. Inventory is grown with the realized cost of goods sold growth rate here in row 46, which is also tied to revenue since cost of goods sold is equal to revenue minus gross margin. So therefore inventory is indirectly tied to revenue as well in this model. Other current assets are grown with sales. Property, plant, and equipment based on the property, plant, and equipment schedule. Other non-current assets, those are grown with the sales growth rate. Sum those up to get total assets. Accounts payable, that's grown with the realized cost of goods sold growth rate that I showed you earlier in row 46. Other current liabilities is grown with sales. Deferred revenue grown with sales. Commercial paper and revolver references a revolving line of credit schedule that I will show later on. Long-term debt is straight lined based on the trailing 12-month number. Other current liabilities I grow with sales. Common stock and additional paid-in capital, that's last year's common stock and a PIC plus the stock-based compensation expense that was in the income statement forecast. Retained earnings, there's a retained earnings schedule, which I will get to. Accumulated other comprehensive income is just straight lines, and that gets me to total equity. Then I do a balance check to make sure the balance sheet balances. That's assets minus liabilities minus equity, rounded to 3 decimal places, should equal 0. And it does for both the trailing 12-month time period as well as years 1 through 6 in the forecast. And the cash flow statement is a period over period reconciliation of changes on the balance sheet. So there's nothing new that's calculated here. I will say for the cash flow statement, it's important to not confuse balances and flows. I'll give you an example of that. You can see here long-term debt is 0. The reason why is because debt from our balance sheet forecast stays at 300 from one period to the next. So 300 minus 300 is 0. Hence, there's no cash inflows or outflows implied from the balance sheet or income statement. So I add all that up, and that gets to net change in cash. Now getting to the property, plant, and equipment schedule. Beginning of period is just last year's end of period. CapEx is a product of last year's CapEx and 1 plus the revenue growth rate. Depreciation is the CapEx times the depreciation that's related to property, plant, and equipment. I start with 70% in the trailing 12-month period and have a 200 basis point step up for each year. So that's how I get that. You take the product of those two. And that gets you to the end of the period once you sum all that up. I also have amortization, which is also going to be 100% of the depreciation and amortization not related to property, plant, and equipment. That's going to be 1%. You can see I have a forecast for that. And that's how I get that. You sum all of that up, and that gets you your total depreciation and amortization. Then you've got other non-current assets. Beginning period is just last year's ending period. Again, the amortization is 100% of the depreciation not related to property, plant, and equipment. That's my assumption there, so it links to row 69. Plus the additions, which is a plug since we already know what other non-current assets is from row 32 of the balance sheet, or of the Excel workbook, which is row 32 is part of the balance sheet within this tab for the Excel workbook. Then we've got the retained earnings schedule. And that's, so you have beginning period, which is last year's ending period, plus net income from the income statement. Dividends, I hold the dividend ratio constant and forecast it that way. Repurchases, share repurchases, I just straight line. That's how I get to my ending retained earnings. So that flows into the retained earnings on the balance sheet. For commercial paper / revolver, I look at the cash at the beginning of period on the balance sheet, less a minimum cash balance. I assume that's 20, so I straight line that. Plus free cash flow generated during the period, which is everything on the cash flow statement except for the net change in cash itself. And that gets me to a revolver needs analysis. Do I need cash, or do I have cash to pay down the revolver, or do I need it to withdraw from the revolver? Moving down here, we have the revolver, which is beginning is last year's end. The draw / pay down is the minimum of C87 and C89, so that's the beginning balance and this needs analysis line in row 87. There's a discretionary pay down, which is just going to be the opposite. It's going to be negative of row 90 to make things simple. That gets me to the end of period balance. So there's no need for the revolver for this company, which is a good sign. Interest expense, that's equal to the total interest expense, which would be interest from debt and interest from revolver. The interest rate is going to be 2.8%, so that's the forecast, and you have the end of period balance from the balance sheet. To get to the interest expense there, and you can see here what the debt balances were for each period from row 38 of this Excel workbook, times a weighted average interest rate 6%. That gets you your interest expense. It's the product of the interest rate times the average of the debt balances. And that's why I enable the iterative calculation to avoid a circular reference. There's a weighted average interest rate earned on cash for interest income. That's based on this interest rate up here, which I straight line from the historical year. So that interest rate times the average of the cash balances. That could also create a circularity, but I've enabled the iterative calculation to avoid that. Then finally, your unlevered free cash flow. EBIT times 1 minus tax rate plus depreciation and amortization minus capex minus change in working capital. Weighted average cost of capital is the amount of debt times the cost of debt times 1 minus tax rate plus the amount of equity, the weight of equity times cost of equity. And so I calculate the cost of equity on the cost of equity tab. I assume the bonds or the loans trade at par. So that's how I get to that. Then I have the discounted unlevered free cash flow. I assume an exit EBITDA multiple forward 12-month EBITDA, which is in year 6, exit at the end of year 5 for 8 times EBITDA. I have the exit price, I discount that, and I add up the discounted unlevered free cash flows to get to the enterprise value. You can see the cost of debt assumptions here. Take this knowledge into the marketplace to be a better financial statement user and a better modeler. Have a great day. Thank you for watching this video. Please subscribe to my YouTube channel, hit the notification bell, hit the like button, leave a comment below, and please buy my books. The links to those will be in the description of this video.